In every era of investing, certain characteristics make or break a business. Today we will also go through one of the most powerful competitive advantages that stands above others, and after that analyze 5 stocks which possess this power. In the past, scale advantages, trademarks, and cost leadership defined the winners. Today, in an increasingly digital and interconnected world, network effects have emerged as one of the most powerful and durable moats a company can possess. They are the modern equivalent of what See's Candy or Coca-Cola represented in Buffett's day, a structural edge that becomes stronger with each passing year. Before we analyze the stocks, you need to understand the power of networking. Network effects occur when a product or service becomes more valuable as more people use it. Unlike traditional moats, brand strength, patents, regulatory barriers, network effects reinforce themselves automatically. Each new user enhances the experience for existing users, raising switching costs, improving data flywheels, and accelerating demand in a virtuous loop. This self-reinforcing dynamic creates a compounding advantage that rivals the best return on invested capital machines in history. In a previous video, I deep dive into the ROIC metric and why Buffett loves it. I will put all other helpful videos on the description. In the digital domain, where marginal costs are near zero and distribution is instantaneous, network effects can scale globally at unprecedented speed. For a traditional manufacturer, doubling production might require new factories and billions in capital. For a network effect platform, doubling users often requires no incremental capital at all. As Charlie Munger frequently reminds us, scale is the new money. And few forces generate scale more effectively or more profitably than network effects. The beauty of network-driven businesses is not just that they grow, it is how they grow. Their economic flywheel typically combines rapid user adoption, increasing monetization over time, high incremental margins, minimal incremental capital requirements, long runway for reinvestment, deepening customer lock-in. Warren Buffett once said that the best business is one that gets more valuable while you sleep. This perfectly describes network-driven platforms. As users interact, transact, create content, write reviews, use payment cards, or perform searches, the ecosystem becomes richer and more indispensable without management lifting a finger. The product improves from within. This is why the market rewards network effects with premium valuations. Investors recognize the rare combination of high growth, high margins, and light capital needs. The strongest network businesses routinely produce ROIC figures that are multiples above the average S&P 500 company. Their asset-light models allow almost all incremental revenue to convert directly into earnings. This can lead them to developing probably the most unique moat of all, pricing power. The evidence is already visible across global markets. Whether it is a payment network, a social platform, a marketplace, or a software ecosystem, companies benefiting from network effects have dominated shareholder returns over the last 20 years. Visa, Meta, Amazon's marketplace, Apple's App Store, and Microsoft's cloud ecosystem all exhibit the same fundamental pattern. The bigger they get, the stronger their moat becomes. Yet network effects are not invincible. Their power can fade if the platform loses user trust or if disruptive competition finds a wedge of entry. Regulation is an ever-present threat to companies whose dominance invites antitrust scrutiny, and as Chris Hohn often warns institutional investors, stagnation is the greatest risk for a network business. If innovation stops, the network stops growing. With these dynamics in mind, the following analysis examines 5 companies whose competitive advantage derives largely from network effects. For each, we will evaluate several important metrics and data sets. To have a network effect is great, but it must be complemented via a set of other key structural advantages, so we must understand and check their revenue model, average earnings growth over the past 5 years, average ROIC over the past 5 years, the net margin, debt to equity ratio, debt to EBITDA, current ratio. These metrics will help us understand the economic strength, durability, and financial resilience of each network effect business and how effectively their moat has translated into shareholder value. In future videos, I will share more metrics which I use, and also don't forget to subscribe and watch the rest of the videos on the channel. Every single one of you knows all these 5 companies, as the essence of a network effect is to have a lot of users on their platform, hence they are all well-known companies. I have prepared a free document with 30 other very high moat companies. Some of them are not well known at all. Grab the free document in the description of the video or the pinned comment. To identify durable compounders, we insist on a set of financial characteristics that reflect resilience, capital efficiency, and the ability to withstand volatility. Remember this checklist, and in other videos I will share other key metrics I like to use when evaluating different businesses. We want a debt-to-equity ratio below 0.8 limits financial risk and ensures a company's growth is supported by cash flow, not leverage. A current ratio above 1.0 signals ample liquidity. A debt-to-EBITDA under 2 keeps balance sheets flexible and safe. Meanwhile, a 5-year earnings growth rate above 10% confirms real business momentum, a net margin above 10% demonstrates economic profitability, and a ROIC above 12% shows that each incremental dollar reinvested compounds intrinsic value rather than diluting it. Each of the following network effect businesses meets or exceeds these thresholds, an uncommon combination of financial strength and structural moat. The first stock is Visa. It operates the world's largest electronic payments network, enabling global transactions between consumers, merchants, financial institutions, and governments. The revenue segmentation is as follows. Service revenues, approximately 36%. These are fees based on payment volume paid by issuing banks for cardholder purchases. Data processing revenues, approximately 35%. Fees for authorizing, clearing, and settling transactions across VisaNet. International and other revenues, approximately 29%. Cross-border transaction fees, highest margin segment, and value-added services such as fraud detection. In regard to the other business fundamentals, Visa maintains a debt-to-equity ratio of 0.66 and a debt-to-EBITDA of 0.98, both comfortably within our preferred limits. Its current ratio of 1.08 signals solid liquidity. Over the past 5 years, Visa has compounded earnings at 13.8% annually, supported by extraordinary net margins of nearly 50% and a 5-year ROIC of 25.3%. These metrics reflect a business that converts scale into economic profits with remarkable consistency. The second stock is Meta Platforms. It operates the world's largest social and ad distribution network across Facebook, Instagram, Messenger, and WhatsApp. Meta's revenue is not diversified at all, as advertising consists of approximately 98% of all revenue. Meta is selling targeted ad placements across its family of apps based on user data and engagement. Reality Labs is the VR/AR hardware arm with only 2% of total revenues. Meta is one of the strongest network effects in corporate history. The company maintains outstanding capital efficiency with a 5-year ROIC of 32.05%, far beyond our 12% hurdle. Its current ratio of 1.98 reflects deep liquidity, while debt-to-equity of 0.26 and debt-to-EBITDA of 0.48 ensure a fortress balance sheet. Meta has compounded earnings at 18.2% annually over the last 5 years, supported by powerful net margins of 30 to 35%. With 3+ billion daily users, Meta's ecosystem becomes more valuable with every additional participant. The third company is Amazon. Amazon operates the world's largest e-commerce marketplace and the leading global cloud computing platform, AWS. The revenue is well diversified. The online and physical stores revenue is around 43%. It consists of direct product sales and Amazon-owned retail operations. Third-party seller services accounts for 23%. This includes commissions, fulfillment fees, and advertising for millions of marketplace sellers. AWS Cloud Services is the fastest and most profitable segment for Amazon, which is around approximately 17% of revenue currently. It has high-margin compute, storage, and enterprise cloud infrastructure offerings. Another very profitable segment is the advertising and subscriptions, again sitting at approximately 17%. Amazon Ads, Prime memberships, music and video streaming go here as revenue items. Financially, the business has transitioned from thin margins to robust profitability as scale deepens. Amazon carries a debt-to-equity ratio of 0.37 and a debt-to-EBITDA of 0.74, indicating a clean balance sheet for a company of its size. The current ratio of 1.01 shows sufficient short-term debt management. Importantly, Amazon compounds earnings at an exceptional 5-year growth rate of 34.5%, supported by a rising net margin of 11% and a 5-year average ROIC of 11.1%, just below our ideal threshold, but rapidly improving as AWS expands. Amazon's flywheels, more sellers attracting more buyers and more AWS clients attracting developers, continue to strengthen its moat. Fourth is Microsoft, a provider of software, cloud infrastructure, and enterprise productivity platforms used globally by businesses, developers, and consumers. The breakdown of the revenue starts with the intelligent cloud, which now is approximately 41%. It includes Azure Cloud Services, enterprise server products, and cloud-based security solutions. The so-called productivity and business processes is approximately 32%. Office 365, LinkedIn, Teams, Dynamics 365 are part of the services. Final is the more personal computing, approximately 27%, Windows OEM licensing, Xbox gaming, Surface hardware, Bing search ads. Financially, it is among the strongest companies in the world, with a ROIC of 28.37%, reflecting elite capital efficiency. Its debt-to-equity ratio of 0.17 and debt-to-EBITDA of 0.32 show minimal leverage. A current ratio of 1.4 ensures strong short-term liquidity. Microsoft compounds earnings at 17.2% annually, with net margins around 35%, driven by recurring cloud, office, and enterprise subscriptions. As enterprises integrate deeper into Microsoft's stack, switching costs rise, reinforcing the network effect. The fifth stock is Apple. They design premium consumer hardware and a tightly integrated software/services ecosystem that monetizes a global base of over 2 billion active devices. The breakdown is, first and foremost, the iPhone sales sitting at 52%, services account for approximately 22%, App Store fees, iCloud, Apple Music, Apple TV Plus, Apple Pay, and warranty financing programs. This is the highest margin segment and where the network effects are hidden. Other products like the Mac, iPad, wearables, and others are 26% of revenues. Apple remains an iconic brand with undeniable network effects. Its device, ecosystem, app store, and services reinforce each other, but its recent fundamentals no longer fit the profile of a high-quality compounder at today's valuation. Apple's debt-to-equity ratio of 1.34 is elevated because of its large liabilities, though its debt-to-EBITDA of 0.69 indicates that cash generation easily supports the balance sheet. Profitability remains strong with 25% net margins and an exceptional 5-year ROIC of 42%, but earnings growth has slowed materially to only 1 to 2% annually over the last 4 years. Combined with a historically high valuation multiple, Apple's fundamentals are the weakest of the 5 companies analyzed. This slowdown and limited reinvestment opportunities is precisely why Warren Buffett has been a net seller of Apple in recent years. In a following video, I will show you how to use practical investment valuation methods, which do not even require any type of high-level math. Complicated math and statistics are called by Buffett very useless skills when investing, so subscribe for more. I'll see you in the next video.